And our next guest says he remains bullish on the markets for a dozen reasons. Joining us now is Ed Yardeni, Yardeni Research president. Ed, thanks so much for joining us. So what are your reasons to be bullish in 2024, especially given, as we talked about all morning, just the incredible rally that we had last year in all the indexes?
Well, the past 2 years, I think, could be described as years of living dangerously, and we got through them. The danger that was widely expected was a recession, and it turned out to be the so-called Godot recession. It just hasn't shown up. I don't think it's going to show up in 2024, and that's mostly because one of the most bullish things that's been happening is inflation has turned out to be relatively transitory. I know I get some backlash on the notion that inflation has been transitory, but the reality is the year-over-year percent change in inflation has come down dramatically, and I think the Fed's target of 2% could be achieved well ahead of schedule. And as a result of that, the stock market and the bond market have been anticipating that the Fed not only is done raising rates, but is going to be lowering interest rates this year. So I think those are just some of the dozen things that may continue to work out relatively well. I also think the market's broadening, which is a very healthy sign.
Yeah, on the point about mission accomplished on inflation, you know, there are still some out there who say, number one, the true lagging effects of interest rate increases haven't really been seen at their fullest yet. And number two, that it's really that last 1 to 1.5%, getting down to 3.5 or 3 was the easier part. It's that last percent that's going to be the toughest and the longest. How do you respond to those concerns?
Well, the reality is interest rates have already come down. I mean, while we're waiting for the Fed to lower interest rates this year, and I'm not in the camp that thinks it's going to be 4, 5 or more rate cuts because I don't see a recession. I think the economy is resilient. The Fed's going to be fairly pleased with the way things are going, and I don't think they're going to want to rush lowering interest rates. So I don't expect an immediate cut, which seems to be some of the thinking out there. But bond yields, mortgage rates have come down, and housing had what I call a rolling recession over the past 2 years, and now it's going to have a rolling recovery. There's also evidence that we're bottoming in the goods recession, the retailing recession. Meanwhile, the services economy remains very strong. So I think the notion that there's long and variable lags, we've been waiting a long time for these long and variable lags to have an impact, and they have in some sectors, but not across the board. With regards to inflation, I think it's turning out to be very spiky. It went straight up, it's come straight down. It does tend to be fairly symmetrical. The risk still is a 1970s style scenario, and that's really more related to the geopolitical risks that are out there. We had 2 oil shocks, oil crises in the 1970s. I suppose we could have another one in the current situation, in which case we would once again have an inflation scare. But so far, as horrible as the situation is in the Middle East, we're not seeing it affecting the price of oil at all. Quite the opposite. The price of oil has actually been coming down since the start of the Gaza war. And that's because there is just a lot of supply. And demand, especially out of China, has been very weak. My bottom line in all this is we didn't have to have a recession in order to bring inflation down. The Chinese did it for us. They have had a recession, and their prices have come down, and that's been good for us.
Yeah, no, they're definitely, China has been one of those upside surprises, at least for us. They're exporting some of the deflation that they're seeing. You mentioned earlier that you perhaps aren't aligned with the market. The market's expecting maybe 6 or 7 cuts this year, starting in March. Do you think there could be a pullback in equities if they don't get a March cut, or there's some language in the next couple of Fed meetings that indicates that maybe they're not on board with 6 or 7? The dot plots just don't show that. Right now they're showing, I think, 2 or 3 cuts. Markets ignoring that.
Well, I tend to focus on the fundamentals of the economy, but I also look at sentiment. A lot of us pay attention to sentiment, and from a contrarian perspective, everybody's bullish. Everybody's too happy coming into the new year. So would you know it? We're starting off on a negative note here, at least on the pre-market open, before the open. But I'm thinking that the market may get disappointed here. last year, the widespread consensus was that the first half was going to be pretty bad and the second half might be better. It turned out that the entire year was actually pretty good. But I'm thinking, if we're going to have to pick which of the halves of the year is going to be on the weak side, it might actually be the first half.